It's a pleasure to speak to you all today. It's good to see many familiar faces, and I look forward to introducing myself and to meet all of you who I don't know. The topic of the conference is what does the London market expect from international loss adjusters? And that got me thinking about what do our clients expect from us, the forensic accountants. Well, the things that sprung to mind are accuracy, the speed of response, professionalism, and the clarity of our work are kind of the main themes. And then I started to think a bit more generally about what do the insurance job, which go well, the insurance losses go well, they have in common. And the one thing that I was thinking of, and I was actually pleased to hear it as well in John's presentation about the survey from AMIC, is a lack of surprises. Is that people don't like uncertainty. So this is sort of going to be the topic of my conversation. This discussion, I'm going to have some examples as well. And as you say, I'll just quickly introduce myself about what we do as forensic accountants. And so about myself, I'm originally from Ukraine. I've been in the UK for most of my life. I've been working at AGL for 8 years, and I specialize in the quantification of BI losses and DSU. I speak Russian, so about 50% of my caseload is based in the Russian-speaking countries, and the rest of it is in UK, Europe, Asia, Middle East. So when we introduce ourselves as forensic accountants, often they can raise some eyebrows. For most people, it can mean different things. It can mean some people think about litigation, some people think about fraud, some people think about the CSI episode they've seen recently. Even if you look at Wikipedia, it's not particularly clear, because it actually suggests that forensic accounting is all to do with actual or anticipated disputes or litigation. And this is also going back to what the AMIC survey as well about I was just thinking that if we get appointed, do people get the impression that this is because there's potential issue? So the first thing that we do when we get involved in a case is to make it clear that the reason we're involved is not because the insurers suspect there's a fraud or they're planning to go to court. Our role in the insurance is quite different. Also, we're not hired guns. We're not there to uplift every stone to find a problem, no matter what. And we're not there to swamp people with the request as well, with the document requests, despite what people think. Right, okay, so just on the next slide, about our role in insurance as forensic accountants. I think the best way, I'm actually going to skip to the next one. This is where we sort of view ourselves in the process. So when we deal with a claim, it's a team effort. And in this team, there's always a loss adjuster, and there's other members as well. There's accountants, engineers, lawyers, industry experts, and surveyors. And the makeup of this team can be different depending on the circumstances and the size of the loss, etc. But the loss adjuster is always a pivotal person, and managing the team is responding to the insurers, is reporting the findings of the team, and also the communication with the clients as well. So the way we see it, that our role is really to facilitate, just going back here, is to facilitate the process, to make the life for the loss adjuster and for insurers as easy as possible. Is to simplify complex issues, because accounting can get complicated, and for us, I think it's a skill if we can present it in a way that makes it easy to understand for everyone. We also prepare scenarios so people can see how the loss can develop, what the final position might be. I think what works well as well is looking back at the cases which have gone well, is that where we have an opportunity to meet with the insured, to have the dialogue, the open dialogue, so we can build a relationship, we can understand their business, and that helps us really to, when it comes to requesting documents, so we can make it very specific. So we can ask for things that we actually need. So as opposed to 40 pages, it becomes 1 or 2 pages. And we're actually asking for the documents that they have, so that means that they don't have to go and prepare anything extra. And it's actually targeted to what the impact of the incident actually is. So I don't know if hopefully that answers the question a little bit. I think it can be a little bit tricky if we're doing the desktop review, where you don't have a chance to discuss the loss or the business even with the client, how the business impacted, and the perception is that you only have one stab at asking all the documents. And you almost have to try to think of all the potential situations where how the loss could have influenced. Some of them might be irrelevant because we might find that there might be different divisions. We think that are all divisions affected by the incident? And maybe it's only one. Maybe the loss is mitigated. So we should be focusing on the increased costs as opposed to looking at the loss of gross profit. So if we have a chance to actually discuss, even the shortest meeting, even meeting the insured once to find out about what they do and how they've been impacted can really help us to focus the request and to make it more smooth, the process. So you might ask, why do we use the word forensic? There's nothing wrong with just being an accountant. Well, forensic, I think the best description is actually what it says is that forensic means it's suitable for use in the court of law. So as an expert to the court of law, we're bound by its rules. And one of the rules is the impartiality of opinion. So this means that when we're meeting with the insured and we tell them that we're independent experts, we can actually look them in the eye and actually mean it, saying that we're not there to catch them. Right, okay, so this is what we do essentially. Now let's move on to the main part sort of the talk, what I wanted to talk to you about, and it's the uncertainty and uncertainty. So one could argue that the clients, when they buy business interruption insurance, they want to get certainty. The purpose of BI insurance is to return a client to the position, financial position, they would have been if there was no incident, subject to the policy terms. So when they insure gross profit, they want to make sure that they can continue to pay salaries, rent, all the other expenses, to pay the bank loans, and to make sure that the shareholders get their proportion of the net profits that they would have had. So they want certainty. And when the incident happens, the insurers turn to you, the loss adjusters, to get certainty. They want to make sure that that the loss is handled well, that is mitigated where possible, that the interests are not being prejudiced. And they also want you to tell them how big the loss is going to be. And sometimes they ask for that question even before you have a chance to see any documents, which can be quite tricky. And what I wanted to talk today about is how the world we live in, the economically, politically, and so on, how it can make it more difficult in some of the issues that come up. And I've got a couple of examples as well from the recent past where things have come up that people were not expecting, they cause uncertainty, and that can potentially cause issues. So if we look at the world as we are now, this is a global risk index as compiled by economists. They update it on I think, regular basis. You know, when you look down this list, you might think like, even 3 years ago, say, you would have thought that some of these issues would have seemed like a bad dream, really, that you see on here. You know, you got Brexit, you've got ISIS, which is now seemingly this big organization all over Middle East and North Africa, which is, is being fought on the different fronts, causing terrorist attacks. You've got potential breakup of EU is on the cards, apparently. There's the Chinese land claims. There's a rise of the right-wing politics in Europe. You've got the sanctions in Russia and the relationship with Russia at the lowest since the Cold War. And you got Mr. Trump, of course, as one of the risks. Well, you have to watch the news because it keeps changing. So maybe I don't know if he's moved down the list already or not. And then as well as the new risk, you've got the old ones. You've got the global warming, you've got the potential food shortages, the overpopulation, energy crisis. There's a lot of risks out there, essentially. And what's interesting as well in this list is that if you look actually carefully, there's no Brexit on here. But if you looked at this 6 months ago, the chance of a Brexit vote was actually considered as a number 3 risk to the global economy. Whereas now it's not even on here, and the vote has taken place. So I don't know if that means that the recent economic performance have shown that Brexit maybe is not such a big risk to the world, but it is going to be important to us who live here in UK one way or the other. So I just wanted to have a look a little bit at this about what the Brexit could bring. So what could possibly go wrong with the Brexit? Okay, for those of you who don't know, this is our Foreign Secretary, Boris Johnson. And he is one of the 3 people in UK who's responsible for negotiating the Brexit. So I think that's probably would have been enough just to leave it at that. But in the short term, what we have at the moment is is negotiations. It's uncertainty because people don't know when things will happen and how they will happen. There's a fear that this is going to reduce foreign investments into the economy. It's going to lead to economic slowdown and potentially hit, well, not potentially, it's already hitting the pound. The pound is already has devalued. And we'll look more into that, into detail. More in the long term, the risk is that UK will leave single market, which can create hurdles for trading with Europe, potential for new licenses. Companies might have to adhere to multiple regulations, introduction of tariffs and duties. There's a risk we're going to miss out to EU-based competition just because of the bad press. Again, this could drive the economy down in UK and the pound as well. And of course, there's a risk that this will impact the global economy as well. It might trigger another crash. It's still a risk. So you might be thinking like this is all very negative. Surely there's some positives potentially as well coming from Brexit. So we should have a balanced view and have a look at that. So what could be the positives? Well, I guess the positive could be that, you know, as we were promised, that we'll no longer have the red tape of the EU. This is going to allow UK to trade internationally, to rebuild the empire, until once again Britannia rules the waves. And you can probably tell which way I voted as well at this stage. Okay, so let's have a look in more detail at what these economic uncertainties, how they can impact what we do. So this graph here is it's a graph showing exchange rate of pound versus dollar. And so far we had a vote. You can probably see what happened. This is where that dip is, that cliff. And essentially, so far the impact on the economy has not been too bad. You know, house prices have dropped a little, but there hasn't been a crash. Okay, pound lost about 15% in its value, but it's actually a good thing for some industries. It's good for tourism. It's good for industries that export goods. For those of you who arrived through Heathrow, probably noticed the big queues because Heathrow is doing really well because the pound is weaker. And this is reflected in the FTSE index as well, which is the share index for the top companies, for the top 100 companies in UK. It's actually at the historical top at the moment. So, but you know, the reasons for that is not there's a Brexit, but there's other factors you have to bear in mind. You know, there's talk about the fact that UK has low interest rates and the US is planning to increase its interest rates. So it actually means that people can be switching from pound to the dollar. The main reason people think there's a drop is just the uncertainty that the investors feel, and they prefer to sell the pound and get to the buy currencies which have less of a risks in the future. And then you have the speculative trading as well, which is potentially driving this lower than it should. Just people betting on the fact that a pound will continue dropping. So, well, you know, reduction in the currency can be fun for some, but for others is less fun. So more specifically, how could this impact us when we look at the insurance losses? Well, if there's a reduction, significant reduction, and the company sells products in outside UK, the margins can increase. This can potentially increase the loss exposures and also potentially trigger under insurance if applicable. Also, if the loss happens and is being reinstated based on products which are imported into the country, or is being mitigated by buying products from outside UK, it can also increase the loss. There's a risk that long-term reduction in the exchange rate, it can trigger inflation because it's going to be linked to the products being brought in, fuel prices, and so on. If that happens, it's likely to change the dynamic of the market. So the supply and demand with the market for particular goods and services. So when we're looking at the trends after something happens, we have to take that into account when looking at the budgets which were prepared before Brexit, and also the historical data. And this can be quite subjective because you're trying to quantify something that no one really knows what the impact truly is. Okay, another interesting thing that can come up is losses and gains on hedges. So I thought I'll bring some accountancy into this at some stage. So I've got a table. And this can happen. So when companies have exposure to fluctuations in exchange rates or commodities, often they choose to hedge their risk. And this is just a simple illustration of a company which buys raw materials in dollars but sells the products in pounds. So they have exposure to fluctuation in the rates. Normally they want to get 60% as their gross profit margin, but it can fluctuate. If the pound drops, the margin drop. If the pound grows, then their margin grow. As they're not an investment bank, they don't want to be dealing with that risk. They just want to get their 60%. So they may choose to take a hedge, which effectively means that if a pound drops and their margin drop, their hedge, which is a financial instrument effectively to think about it, it has a gain and it offsets that loss, so it brings them back down to the get. Also, if the pound grows and their margin becomes bigger, the hedge has a loss and it brings it back down to 60 again. So effectively just make sure that they get what they want to get, and if they're not interested in the commodity risks or exchange risks. And there's an interesting example from the past where this was an issue. This is a loss I worked in the Middle East. It's a sugar refinery, which it purchased raw sugar overseas. It was priced in dollars, and it was priced based on the quoted raw material prices. So it takes some time to arrive by the boats, then is refined and then sold locally, and some of it was exported locally to the neighboring countries as well. So this business had quite a lot of exposure because they always had quite a lot of stock holding of raw sugar, which was bought in dollars based on the commodity price of raw sugar, which can be quite volatile. And effectively what they did, they had all these hedges set up to make sure that their margins would not be impacted if the commodity prices change. You've got the raw sugar prices, refined price, and also the exchange rates. So all of those things were hedged, so they were completely locked into a particular margin, which is really good. What happened, they had an incident, and the factory shut down for some time. They had to cancel some of the purchases. So there were costs associated with that, and there were losses on hedges that come up. Normally those losses would have been offset by the margins, but what happens is that in the policy, the raw materials were uninsured. So you can see how this raises interesting questions about where does this fit into the policy. And you could argue, there were arguments it could be increased cost of working, but then you have to try to think, how does this loss on a hedge mitigate a loss? Or is it an additional increased cost of working? So is it a cost incurred to continue the business operating? I'm just trying to say that this is not, it just adds uncertainty. And for a business which thinks that they're fully hedged, that they should get exactly what they particular answer, and they have insurance if something goes wrong, it just introduced a level of uncertainty which made the settlement process a little bit more complicated. I've got a couple of more examples before we break for lunch. And one of them, when you see this graph, you're all going to recognize this is the crude prices and their drop in the late 2014. So with crude, the prices of crude, they change for different reasons. You've got the political risks, you've got the economic condition of the world, you've got the discussions in OPEC, and so on. So there is a chance that in the future this graph will change. There's talk about Russia and OPEC reaching some kind of agreement, so which might result in a positive. If there's another crash in the economy, I don't know if it can go any lower really, but it can change effectively. And so I just wanted to discuss with you a couple of examples how, when this change has happened in 2014, how it impacted BI losses. So first example is a refinery in Russia. So this is quite a big refinery in Siberia. It consumes own oil, meaning that part of the company produces oil and exports it overseas. They make finished goods and sell them locally mainly, and some of them are exported as well. So they had a severe damage right in the middle of 2014 before the prices started to drop. So you had that drop following immediately from that. Now, so when looking at this loss, there was a considerable risk or perception that if the crude prices are dropping, this could really increase the margins. And when you see that graph with the dramatic fall, the margins can really increase. So it could increase the value of the loss. There was an average on this policy as well, so there was a consideration that we needed to bear in mind, especially when the indicators were that the selling prices were actually quite stable in Russia. There was no real drop. Now, what happened, like on a closer look, is what we've got here is that if you look at what happened to the Russian ruble, you're going to have to read to find out which one is which, because it almost looks exactly the same. So black line is the crude prices in dollars, and the red line is what happened to the ruble at the same time. So it dropped almost exactly the same way, which some say is the indication of Russia's over-reliance on the natural resources, because their currency and economy reacts this way. So when you looked at it this way, and when you calculated what the price of crude was actually in rubles, which is the orange line at the top, you can see they actually remained fairly stable, a lot more stable than the price of crude in dollars, which meant that this increase in margin that we were worried about, it didn't actually happen. There were two other factors which impacted this, in fact. One of them was a political one, the fact that in Russia they've changed the rules about how crude exports and also refining of products is taxed, which actually squeezed the margins for the refiners. So in fact the margins reduced after the incident, which is completely contrary to what one might expect when looking at the crude prices dropping. And the other factor as well was that the policy was, the loss was mainly reinsured outside Russia. The policy was in rubles, so the insurers were paying for loss in rubles, and because ruble has dropped so much, the value has reduced quite significantly. So you can see that you've got all these factors. You've got the crude prices, you've got the currency fluctuations, you've got the political risk from the taxation, and you try to, so it just makes it tricky to say early on what the loss is actually going to be. And this is just, I think, a good example where all of those different things actually played an important role. And then the final example I've got is also to do with crude, and this is a refinery in Southeast Asia. The unique thing about this refinery is that it's located inland, but it was consuming crude brought by ships from the Gulf, and the crude was supplied by this pipeline, enormous pipeline, all across India. And effectively the loss happened as well in 2014, and just before the crude prices started to drop, the refinery stopped completely and restarted later 2014. At that stage, crude prices dropped quite a lot, and there was a lot of crude sitting inside the pipeline. And effectively during this period, the value of that crude just dropped, they lost almost half of its value. So again, this just added a level of complication, like how does this fit? Is this a devaluation of stock? Or is this a different way of looking at it? Is this an erosion of margin? Because after they restarted, the refinery was consuming this expensive crude oil that they bought in the summer and selling their products at the lower prices because of the crude drop. So they have this erosion. And the interesting thing here was that the value of this erosion varied hugely depending on how you value your stock. In accountancy, you could look at it as a first in, first out, average, or last in, first out. So basically you're matching sales or finished goods and your raw materials, and you either take the one from the summer, match it to the sales, or you take the price from the current price, match it to the sales. And to complicate the matters, the insured was actually in the process of changing the way they value stock. And because we have to follow the way they do it in their accounts, it just created a whole lot of discussions and uncertainty, which probably not something they envisaged when early on, when you were looking at mitigating the risks and getting insurance. Okay, well, this pretty much brings me to the close. I've got a potentially cryptic slide, but essentially what I wanted to conclude with is that, clearly we live in the turbulent times. There's a lot going on. There's a lot in the news, and we've got Brexit coming up as well, and at this stage, no one knows what it's going to do. You know, it could be good, it could be bad, it could trigger economic crash, or it could not. You know, it's only speculations. And the thing is that what you can do is it can impact the exchange rates, commodities, and so on and so on. I'm confident that you know, the London market, you, the adjusters and accountants, we actually have all the skills necessary to deal with, because we've seen it happen in other countries all over the world. You know, this is the advantage of international adjusters, because you've seen it all before. So I think we'll survive. I think essentially is my message. So with that, thank you for your time, and if there's any questions, I'll be happy to answer or just chat with you later today.
Thank you, Vlad.